This one parameter affects stock price more than anything else in the market. Understanding the market. Earnings per share. Earnings per share, or EPS, is one of the most commonly looked at and estimated statistics in the stock market community. But what is EPS? It is simply the net income of a company divided by the shares outstanding. That is, the shares that are available for trade. Let's look at an example for Coca-Cola, ticker symbol KO. The net income is the total revenue minus some variable expenses such as cost of goods sold and your operating expenses, and then also minus some fixed expenses such as your overhead, and that is how you achieve your net income. You divide this net income by shares outstanding and you get your earnings per share. In simple terms, it is the company's profit per share. How is it used in the financial community? Every quarter, public companies are required to make a statement releasing their EPS. These statements are titled earnings calls. Before these statements, tons of Wall Street analysts do deep dives into the company's books and news and any other public information to create an earnings forecast. If the company's actual EPS is over the estimated or forecasted EPS, the stock price tends to go up temporarily. If the company does not do as well as predicted, then the stock price tends to take a temporary dip. This is what earnings look like on the Robinhood app. Now remember, we are long-term investors, so we do not care about the temporary price movements that come after earnings calls. So while everyone is freaking out over the earnings calls, you can just sit back and relax because they will not affect us. Another issue with EPS is that it strictly just looks at your net income over shares outstanding. And there are ways to change those numbers without actually changing the fundamentals of the company. For example, stock buybacks are a way that the EPS can artificially get pushed up. If a company has the same net income, but they use some money to buy back some shares and their shares outstanding goes down, then their EPS will go up without the company actually becoming any more valuable. Also, a higher net income can be attributed to more leverage. Leverage being the amount of debt that a company has. So if a company is over leveraged, that is, it has an unmanageable amount of debt, that could push net income up and create an artificially high EPS. Finally, EPS does not look at the balance sheet of the company. Two companies could have the exact same EPS, but one could have half of the assets of another company, which means that the company with less assets is far more efficient, but the EPS does not show that. These are just some issues that arise when strictly looking at EPS. This is why it's important to always look at multiple figures when you do your analysis. That's all for today. Make sure to sub for daily videos and see you next time.